Hi, and welcome to this week's market presentation. Latest news. In the latest developments in North America, the US federal government shutdown finally ended after 43 days in what became the longest shutdown in US history. With the return of the federal government to full normal operations, economic data publication is expected to resume, although the White House has already stated that some October data may not be released after all. While the government has resumed operating with funding legislation funding it through the end of next January, new funding crisis is certainly on the table starting in February unless a longer-term funding solution can be agreed upon in Congress. In the midst of all this, the Federal Reserve is expected to continue its interest rate cut during their next meeting in the middle of December, with uncertainty as to how they will act given the lack of economic data they may still face then. The probability of a cut, however, remains around 45% amid the mixed employment signals with signs of a worsening labor market, even as inflation remains above the Fed's target. Over in Asia, China's economy continues to show signs of a deeper slowdown in its activity. All economic indicators for October came in below expectations. Some key highlights are the fact that property prices accelerated their decline, with investment falling 13.9% year over year. Retail sales also slowed down to 2.9% year over year, with industrial production slowing by 4.9%. The impact on markets is likely to lead to a reduction in demand expectations, particularly for crude oil and for natural gas in the coming months and years. Despite the above, coal imports have risen as domestic production constraints have persisted, so coal prices could see a slight boost as well. Moving on to South America, President Trump has threatened military action against Venezuela with the prospect that the U.S. will name narco traffickers as foreign terrorist organizations and name Venezuelan President Maduro as the leader of one such group. The U.S. military buildup around Venezuela has now swelled with the incoming U.S. Gerald Ford, the U.S. Navy's most modern aircraft carrier. Maduro has called on Russia, China, and Iran for military assistance against U.S. threats, but given U.S. military power in the region, if the U.S. were to take military action, it seems unlikely that the Venezuelan army would be able to hold on. Crude prices have faced immediate risk premium increases due to the potential supply disruptions, given that Venezuela holds the world's largest oil reserves at 303 billion barrels. We could see impacts of upwards of 1 million barrels per day of Venezuelan exports, with the impact disproportionate on heavy crude exports, being very critical to U.S. Gulf Coast refineries. Diesel margins are likely to surge as well in Europe and in the US as refinery feedstocks imbalances. But for the moment, nothing has yet taken place, but tensions certainly are on the rise. And lastly, we take a look at some of the key insights from the International Energy Agency's World Energy Outlook published recently. Some of the key developments they highlight in their report are the expected big increases in global electricity generation powered by AI, the impacts that that will have on the energy mix globally, with current policies, particularly in developed countries, leading to a continued reliance on fossil fuels with not enough investments into renewables. Lastly, as the AI revolution that is powering this surge in electricity demand is very much based on important and key rare earth minerals, and the fact that China dominates 19 of 20 of these critical mineral supply chains, it will be increasingly important to manage those relations between Europe, the US, and China. Looking at some key insights here, the IEA forecasts that electricity demand growth will outpace total energy demand growth by a wide margin, with renewables accounting for an increasing surge of the surging electricity demand, although that is much more prominent when we look at the stated policy scenarios instead of the current policies that are in place. Looking at the dependence on fossil fuels, given current policies, we'll see a continued dependence on fossil fuels, particularly oil and natural gas. which are not expected to peak until 2050, compared to the stated policy scenario by the IEA, which would see oil and gas demand peak in the 2030s and clearly see a decline into the 2050s. Overall, when we look at the current policy scenario, we could see oil and gas consumption continue increasing through 2050, while given the stated policy scenarios amongst the various countries involved, we could in fact see that oil demand stops growing around 2030, with natural gas demand reaching its maximum level around 2035. And very importantly, the huge increase in renewable power generation, which continues to grow very strongly, growing fourfold by 2050. In terms of emissions, the various scenarios have huge differences, with the stated policy scenario seeing a sharp decrease in global emissions by 2035, while the current policy scenario would see those emissions remain much higher in the coming decade. The impact of seeing that continued increase in carbon emissions would see warming close to 3 degrees by 2100 in the current policy, with warming of upwards of 2.5 degrees with the stated policy. Even when we look at a scenario of net zero emissions by 2050, we would still see increasing temperatures of around 1.5 degrees Celsius. Lastly, as I mentioned earlier, the big driver of the growth in electricity demand globally are the huge increases in investments into data centers, with $850 billion worth of investments this year alone, outpacing investments into oil exports and extraction by roughly $300 billion. China and the US dominate the data center capacity expectations. And also what we see is that the majority of data centers in the pipeline and under development are larger than 200 megawatts and are oftentimes in clusters in and around large cities, and as I mentioned, mostly located in the US and China. Now, for the US, this is particularly tricky given that China dominates the rare earth mineral market, which, as we can see here, China is the leading producers for nearly all of the 20 energy-related strategic minerals analyzed, with an average market share of around 70%. This will give China increasing leverage in their relation, and will be important for the US, but also countries in Europe to diversify and invest in those rare earth mineral capacities. Lastly, we're looking at LNG markets in particular. We see the huge increases in LNG export capacity, fueled primarily by very rapid growth in the United States, followed by Qatar. When we look at the evolution of LNG export capacity compared to the expected market for LNG, what we note is that depending on the scenarios, we could end up having a very adequately and well-supplied global gas market by 2035 under the stated policy scenario. Or under the current policy scenario, we could still see a relative tight supply and demand balance by then. Weather. Moving then on to the weather forecast, we note cold weather coming to Europe, with forecasted temperatures falling below the seasonal average over the next 7 to 10 days. The coldest temperatures will likely be felt in northern Europe, with the Nordic experiencing temperatures as much as 10 degrees below the average. In terms of precipitation, the colder weather will also bring greater levels of precipitation across Europe, a welcome sign for hydro storage levels across the region. And lastly, the better than average wind speeds as of late, which have boosted wind power generation, are expected to continue at the beginning of this week. Macroeconomics. PMI figures were released for the month of October for the global economy, showing a slight improvement in the global PMI, staying more or less stable versus the previous month, but at a slight improvement. We also have PMI figures for Europe for the month of October, which showed a relatively stable stable evolution when it comes to the manufacturing sector, staying at just around 50 points, with the service industry showing greater growth at a PMI level of 53. Crude oil and LPG. Crude oil prices globally continued their bearish price evolution, pushing the price of WTI crude oil below the $60 per barrel price level, with Brent falling below $65 per barrel. Overall, when we look at the market, we continue to see signs of an oversupplied market. This was confirmed by OPEC Plus in their latest statements, the reason for their pausing of future production increases. Overall, the EIA in the US continues to forecast a very oversupplied market, especially in the beginning of 2026, with limited changes over the previous month. Natural gas. Looking at natural gas prices here, we note the bearish price evolution in gas markets in Europe, both in short term and further along the curve. Overall, we see the milder weather we've had across Europe decrease or weigh down demand expectations, while at the same time, the nice improvement in LNG imports up to an 8-month high, and the continued availability of LNG globally that Europe is able to import has significantly improved the supply outlook moving forward, adding to the downward pressure in the market. In terms of European gas storage levels have remained relatively steady, seeing a slight decline over the past week as we've moved into net withdrawal territory, but at a more modest pace than we've seen in previous years, which has actually narrowed the gap in terms of the storage deficit versus the previous year. Looking at the level of injections and withdrawals, we see a clear move into withdrawal territory, although as you can see here, slightly at a less steep decline as the average since 2012, and noticeably better than last year's levels. In terms of total supply and demand, we note on total supply side of things that slight increase that are accommodating the increases in demand, which, as we can see on the right-hand side, has been steeper, largely driven by the colder weather in Europe, increasing heating demand. But nonetheless, we still see total demand below the past 5-year average and below last year's levels. Looking at the supply mix, we continue to see that improvement and that increase in LNG sendouts, in part driven by LNG imports being at an 8-month high in Europe, with most of that LNG continuing to come from the United States. Other signs of the bearish sentiment in the market is seen by looking at investment funds positions, with the level of short positions increasing further over the past week, with the level of net long positions near the lowest levels we've seen since earlier in 2024. Coal. Coal prices have shown quite a bit of stability over the past week, remaining more or less in line with where we were about a month ago, just slightly lower. Overall demand in Europe remains more limited, in part because of the high carbon prices and lower gas prices, incentivizing less coal consumption from the power sector. And then in terms of heating demand, the milder temperatures we've had across Europe have certainly kept demand lower. Now, given the colder weather that's being forecasted across Europe, we could see an uptick in coal consumption there. And lastly, when it comes to coal markets, we still see very adequate levels of coal stocks at ARA terminals, further reducing demand for new arrivals. EU and UK emission allowances. Looking at carbon allowances, we see a further increase over the past week, with European carbon prices increasing around 2% on the week, with the UK prices moving up 3%. European allowance prices in the spot market continue to move up in a more clear bullish signal, with the market for December 25 allowances showing a little more neutrality with a less clear upward trend. Nonetheless, we continue to see the upward pressure due to the expectations of a tighter supply situation starting in 2026, add upward pressure to the market. And then additionally, as we've been mentioning throughout much of this year, the expectations of a linkage between the EU and UK markets continue to add pressure to the market, with this past week the EU moving forward with those discussions, further fueling those expectations. Looking at the power sector emissions, what we note is that emissions year to date and as of late have remained below the past 5-year average and below last year's levels, which has been one of the factors that could have been limiting some further increases in the price level for carbon allowances. Nonetheless, further signs of the bullish sentiment in the market are seen by the investment funds positions, when continue to be at record high net long levels, with the level of long positions on the European market reaching over 100 million tons. Electricity. Electricity prices in Europe are seeing a different price evolution than natural gas, with the shorter term seeing a more neutral price evolution and some more bullishness further along the curve when we look at the Cal 28 and beyond prices. That could very much be due to the expected increase in overall electricity consumption in those coming years as more data centers and that AI-driven electricity demand growth kicks in Europe. Most European markets are following a similar price evolution as the German power market. A couple exceptions would be on the Polish side, which has seen a stronger upward trend in the price level over the last couple of weeks. And on the other end, you have France, which continues to see low electricity prices, with the Cal 26 price continuing to move into historical lows on the back of strong nuclear power output expectations. In the Nordics, we've seen a similar price evolution as with Germany, with a slight uptick to neutrality over the past week. Here, the more precipitation being forecasted, certainly weighing on the market as well. Looking at total demand and residual load, we see total grid demand still below the past 5-year average and close to the lowest levels over the past 5 years. In terms of residual load here, we see the residual load increasing over the previous 2 weeks and a slight downturn last week, very much again near the lowest levels in over 5 years. French nuclear power generation continues to perform at quite nice levels, at near the highest levels over the past 5 years, in line with last year's levels, with expectations of further improvement as we move through the summer and into next year. On the renewable side of things, we're once again seeing that uptick in wind power generation as wind speeds are improving over the past week, moving a little further above the past 5-year average. On the other hand, when we look at solar power generation and hydro reservoir generation, we do see a downturn over the past week, with the seasonality of solar output decreasing total output there. Then looking at fossil fuels, we see the increase in fossil gas power generation as we see that decrease in wind power output. So very much seeing an opposite evolution when it comes to gas and wind. While looking at the coal side of things, we continue to see quite weak demand for coal across Europe, which is one of the reasons why we're seeing those coal prices remain at relatively lower levels. And lastly, looking at the evolution for guarantees of origin, we see a little more neutral price evolution in the shorter term, but nonetheless, we continue to see guarantees of origin pricing push to new lows this year, with the price for 2025 production year GOOs at the lowest levels we've seen in close to a year and a half. Further along the curve, we're seeing a more clear bearish price evolution there as well, as expectations of that continued increase in total supply are easing some of the bullish sentiment in the market. That covers this week's market presentation. Thank you for joining.